You know, that's the thing too. If you're going to go back and listen to a lecture, whatever this bullshit is. You know, if you're going to listen to me talk again, don't listen to the same one, right? Listen to the other class. Because it's going to be something different, right? And you already heard the first time, but it's all the same stuff, right? Or you can go back to those prior ones if you want. I don't care how you learn this stuff. I told you guys that, right? You're kind of in charge of that. What I would do is I'd read the chapters before I got here. You're doing that now, aren't you? Before I talk about them, so you have a clue what I'm talking about. It's hard to read them without me having talked about it first. If I talk first and then you go read it, you'll get more out of the reading, but you get less out of me talking about it. So I think it's better to do the reading first. Try to do some problems. Come in here, right? And I'll talk about it. And then go back and work some more problems right away. And how do you know when you're done working problems? When you don't ever have to look at the book, you don't have to think about it too much. You just look at it, I know how to do that, and you do it. Fast. Right? It's no big deal. So you go to another one that's similar, and this is ridiculous. I'm wasting my time. Then stop doing it. But if you're still looking back at the book, you're still copying what the author's doing. Don't do that. Right? You know it. That's all. Okay? And I don't care if you ever watch one of these videos. If you know what you're doing. If they're helpful, do it. Okay? Students tell me the nice thing about the videos is they can scan through and find what they want. They don't have to go to a review session and listen to the whole thing and listen to me talk about things they already know. They can look at the video, scan you the problem they don't know how to do, and listen to me talk about it, and, you know, go on. Go on with your life. Study something else. I never like to learn what I already know. I only like to learn what I don't know. What do you think I say for that? Good strategy. If you're ever going to study for the CPA exam, I'm going to if you become an accounting major, I'm going to suggest to you that you do a diagnostic exam, find out what you know and what you don't know, and only study the stuff you don't know. What do you think? If I'm at work, you know, and you're working for me, I want you to go study in your own time the stuff that you don't understand that we're working on. Not the stuff you do understand. That's kind of easy, right? Don't do that. Wait. Instead, grab a beer, relax. You know, a good meal. No, you're underage. You're all underage. Is anybody 21 in here? No. Well, we can have a beer. They can't. It's illegal, you know. For them, it's good for us. It's bad for them. Great society we have. I just don't understand. Why can you die in wars? Never mind. Yeah. When you're 18, actually, I guess you can do that when you're an infant, but you can go to war when you're 18. But you can't drink. We can let people vote, and we won't let them drink. We let them own guns, and we won't let them drink.
Not in Kentucky.
In Kentucky?
Well, you can have your concealed carry in Kentucky.
Oh, you can?
21.
Oh, really? Mm-hmm. Oh, that's why we're so much safer here. That's good. Yeah. Well, that's
I don't know.
I don't know. Probably people that are 18 are better with a gun than people who are 85. What do you think? Who's a little sharper, a little more alert? You know, 85-year-old person wandering around with a gun. Okay, but they still have their right. Yeah. Anyway, wow. It was an interesting thing on NPR this morning. My wife had a touring area listening to these people in Iowa, and they found them, you know, the worst of the worst. But this guy had 4 people show up in his yard at 11 o'clock at night. They were out coon hunting, boonies. So he got his gun and went outside and scared them away because he didn't know if they were coon hunters or terrorists. I don't know. Odds are, yeah, so. And they still asked, he says, well, they asked me if they could hunt on my property. At 11 o'clock at night, can you imagine that? Luckily, you didn't shoot him. Yeah, so, anyway. Interesting world. So what do you guys want to do? What problem was it?
On 7D, you just wrote like a little note, and I didn't know what it was.
Because you can't read my writing?
Yeah.
7D. It says, cut hair for customers totaling 800. 600 was paid when the haircuts were done, and the remainder will be paid later this month or perhaps next month.
No.
So what's my note saying?
I put revenue, and you counted it wrong.
Oh, because it's just revenue. How many kinds of revenue are there?
I mean, I know there's a lot, but I
Here
just
you
didn't know
go.
which one it was.
Revenue, we have 2 basic types. Service revenue for
Okay.
services. Could have done that. Or you could have done sales. Right? Okay, tell me, you guys.
Okay.
When would we use service revenue and when would we use sales? What are we selling? I think you use service revenues when you are selling services. I think we use sales revenue, and you can put the word revenue on it for now, would be a good idea, so you know it's revenue. Sales is a type of revenue. A lot of companies would just say sales, they know it's revenue. When do you do that? When you're selling what? Merchandise, right? Books, computers, right? Land. Okay, that answers that question. Is that all you had, really?
Well, I have a couple more questions.
Now, what's the journal entry for that? Let's do it. We had to go over there. Real quick. Cut hair for customers totaling 800. Why do you cut hair? To earn revenue. What do you want to call this? Haircut revenue, or haircut service revenue, or just service revenue? Doesn't matter. Whatever the company wants to do. What do they get? Cash, which is a asset more. What else do they get? Accounts receivable. They're going to get paid later. See how easy this gets? You know, you were talking about people, how many you're going to drop. They're not here, and they don't know this. Are they going to be competitive with you guys? No. It's all right. You know what's really fun? Competition's weak. You can get rich. I could. People who learn a lot and work hard get paid well. In a meeting yesterday, we were talking about somebody who has a master's degree and makes $40,000 a year. He's 45 years old. Holy shit. You guys are going to get $50,000. 55 maybe. When you are 22 years old and graduate from this place. What do you think you'll be making when you're 40? You keep working hard. Probably not 40,000. So then, when we were talking about how this person doesn't know what they're doing, die, right? They ever get in that position. And by the way, they've had their master's degree for 10 years or something. My gosh, don't be that person, okay? Just sitting here talking about how we're going to politely tell them to go work somewhere else. This organization. So, don't be that person. Why am I working you guys to death? I don't want you to be there, okay? I really don't. So, yeah, it'd be ill to think about it. Okay, what's your other one?
Well, for this back page, I just didn't know how you graded it, so I didn't know. Like, we went over what was right and wrong. So I was just like...
Which one are we talking about? 8? Number 8?
8, 9...
What do you have to do on 8? Do all your journal entries. The only way you're going to get 8 is if you did all your journal entries right.
Yeah.
And then you record the debits and credits. But what I would have done on 8 is I would have set myself up. Come on. Okay, so. Okay. I would have set myself up like this. Give you another one. Assets, liabilities, equity. Give you another one. Revenue, and expense. And I would have taken all my journal entries that I did. When I debit an asset, debit it. When I credit an asset, credit it. Same with liabilities and equity and revenue and expense, right? Then I'd add them all up. And then what would I want to do, guys? Make sure the assets equal the liabilities plus equity, right? These assets have to equal the liabilities plus the equity. And remember that revenue and expenses are a subset of equity. So the difference between your total revenues and your total expenses is the net income, which gets added to equity. True? Did that? Did you do that?
Well, yeah, I just...
But if your journal entries are wrong, it makes the numbers wrong. Oh, well.
Yeah, well, I don't know. You put an X through one, but all the rest of them are like tick marks. I didn't know if they were right.
That makes it right.
That makes it right.
2840 for assets, liabilities 400, equity 2440, revenues 800, expenses 360, net income 440.
So you always add your net income to your equity when you're doing these?
You better. What do you do when you do that closing entry you read about in chapter 4? Want to do a closing entry, you guys? It'd be a really good idea. Why don't we do that? I guess we're going to stay on one page, your class. I don't know if we're till the last class. Okay, so what's a closing entry look like? Let's make it a real simple company. I have one revenue account, right? Really, I have 50 of them, right? But I got one revenue account with $100,000 in it, okay? And I only have one expense account. Really, I have 3,000 of those, right? Whatever number you got. There's 80 in there. What's my net income, everybody? 20. True? Okay, let's do a closing entry. When would you do the closing entry? The very first millisecond of a new year, right? You guys know when one year ends, the next one begins? No transactions in between, okay? So I've got all my revenue accounts add up to 100. All my expense accounts add up to 80. They are temporary or nominal accounts. You read about that, right? We're going to close them and start over with the new year. So remember, I've said many times that the revenues and expenses are temporary or nominal equity accounts. They're a subset of equity, aren't they? So here's the deal. When I close this, how will I make the revenue be zero to start over? Close it with a what? Yeah, but what do you do to the revenue accounts themselves? Every single one of them, what do you do to them? They have credit balances. How do you make them zero? Come on. Debit. So I debit this by 100. Am I right? So all your revenue accounts, this is a closing entry, huh? All your revenue accounts get debited by their balance, and now they're nothing. To start a new year. Everybody see what's going on? Now we got zero, and we can start a new year. Start counting a new year. Okay? But all along, they're really part of equity. Because as you earn revenues, you're worth more, aren't you? Right? Okay, that's where we have to add it. What about the expenses? What are you going to do, guys, to close it? Yeah, there's your closing entry. And that's going to make it zero, and you start over, okay? Start a new year. So all the expense accounts, all 3,000 or whatever you have, get credited. And then what's the difference? The 20, where's it going to have to go? Income summary, they say, but that's a temporary account that we hold it in until we close it to retained earnings. So that net income goes into retained earnings. Now that's physically how it's done, okay? But every time you make a journal entry throughout the year, let's say that we sell something for cash. We debit cash and we credit service revenue, sell some services. What's happening? I increased my assets, but I did nothing to equity directly. You better pick up the net income, huh? Or you'll be out of balance. See, there's nothing over here, is there? But yes, there is. As I increase the revenue, it increases the income, which increases equity, and I stay in balance. But I haven't made the closing entry yet. So if I'm doing monthly statements or quarterly statements, what do I have to pick up? The net income's got to get added to the retained earnings. That do it? Yeah. That's it. So all your expenses are the same way, right? You debit an expense and credit a liability, or debit an expense and credit an asset, right? You better pick up your expenses and your revenues. So you can just pick up the net income, of course, or net loss. That's a great question. Okay. So we good?
Oh, I don't know. I didn't understand how you graded some of it because it looked like you should have added.
I'll look at it after class. That's fine. Yeah, okay. Challenging how I grade things. Okay, so what should we cover, guys? You want to do a problem, maybe? We could do, what have you been working on?
I was just looking at, we don't have to go over this, but on the practice test, up here on the very first one, it wants you to find the retained earnings.
Yeah.
So you just do, but you're going to have to make it a deficit because...
Oh, what would a retained earnings deficit be? Right? What's a retained earnings deficit? What do you think a deficit is? You're in the hole, right? What do you think retained earnings is going to typically be? We start the company, running the company, we have zero retained earnings, right? We have zero everything when we start the company. Everybody agree with that? No assets, no liabilities, no equity, no revenue, no expense when we start. Okay? How do you get retained earnings? You earn net income. Every year we put our net income into retained earnings, right? Year after year after year. With that closing entry we just looked at, right? And you've read about. Okay? What else happens? Maybe. In your first 5 years of the business, now it's a lot. You don't make net incomes, what do you have? Net losses typically. I'm not kidding. That's why companies go bankrupt in the early years. Never turn a profit soon enough. Go broke. Okay? And we'll talk about that stuff. So net loss, whatever they are. For the whole life of the company, all their net incomes go into retained earnings, and all their net losses come out of retained earnings. Year after year after year after year. You only have one or the other each year, right? Either you're made money or lost money. What else comes out of retained earnings? Dividends. So dividends come out of here too. Any year you pay dividends. Got the idea? Okay. Typically what you'd see is a credit balance over here, right? Why would that be? because your net incomes over the life of the company are more than the net losses and the dividends put together. Does that make sense? What happens, though, if you have, I don't know, horrible results, maybe from the beginning or maybe like General Motors later? General Motors managed to get rid of all the earnings they had ever had because their losses were so big. And they ended up with a deficit. Retained earnings, debit balance. It means you're in the hole. So I'd have a debit balance and retained earnings. I've lost more than I've lost and paid dividends. General Motors also paid lots of dividends over the years because they were rich. Thought this was never going to happen, right? And they went bankrupt, basically. I know General Motors still exists because taxpayers invested a whole bunch of money in the company. We got paid back, by the way. That didn't work out too bad. The auto industry paid us back. Everybody says, oh, we bailed out the auto industry. That's true. We wanted to save all those jobs, right? We didn't want to only be able to buy foreign cars. We wanted to be able to buy U.S. cars. And we bailed out Chrysler and General Motors. Did not have to bail out Ford, right? But otherwise, we would have one auto manufacturer. We saved thousands of jobs, U.S. tax dollars at work. But what's really cool about it, and the Obama administration gets credit for this. Sorry, they did it, although George Bush wanted to do it before when he was leading the presidency. Obama implemented, right? So I don't know, he gets credit. Who cares? Anyway, so what happens then is we gave him a whole bunch of money and he says, we'll never see that again. 3 years later, we had it all back. It was a great investment, fantastic investment. I don't know. So anyway, it's a mixed bag, you guys. Okay, anyway, so, that clear that up? Good. So how would you start that? Debit balance and retained earnings. Work your way forward.
So just whenever we're writing that out, you just want to like the answer to this is $60,000, and just write deficit next to it.
Mm-hmm. Yeah. Mm-hmm. You bet. Well, isn't there a spot to either say?
Yeah. What says debit deficit? Do we have to write debit if we're just put it down?
No deficit. Okay. So, want to do a problem maybe? Let's do a few. Let's do some adjusting journal entries on 4.6, exercise 4.6, page 190. Did you guys give that one a try? Dittman's Variety Store is completing the accounting process for the year just ended, December 31st, 2014. The transactions during 2014 have been journalized and posted. What does that mean? It means all the source entries, every time they bought something, sold something, everything they did, right? They made journal entries for it. You know, debit cash, credit sales, debit supplies inventory, credit accounts payable, then debit accounts payable, credit cash, all this stuff. All your payroll's been done, right? So they recorded stuff, okay? And so what does that mean? Journalized is recording the entry. Posted is putting it in the general ledger, which we represent with T accounts. In the general ledger accounts, computer record, debit, credit, debit, credit. And so we know what the balance is after doing a whole bunch of business activity. Got the idea? And our general ledger would be in balance because we always make sure our debits equal our credits. And a lot of this is done by the computers, right? Okay, we program the computer, set it up, it's automatic. Like I said, when you go to Kroger and you buy something, and you buy a can of green beans. Does anybody really buy cans of green beans? But anyway, you scan it, right? They scan it, and they are going to debit cash because you gave them cash, and they're going to credit sales for the sales price, and they are going to debit cost of goods sold, and they're going to credit inventory for the cost of that can. And then they are going to automatically reorder when they've sold enough of the cans. Not kidding, okay? So the computers are doing wonderful things for us, right? Keeping track of all that stuff. But it's still these debits, credits, debit credits, right? So when you look at a financial statement for Kroger, you're going to see millions and millions of transactions all added up. And you're going to know where they came from. That's what we want. I want you to know what you're looking at here. It represents people really doing stuff, okay? So you're capable of running a company because you know what's going on in the company. And I don't mean you really know what's going on by reading a balance sheet. You might have to go to the stores too, If you're the president, I hope the president and CEO of Kroger actually visits stores sometimes, don't you? Right? Instead of just looking at reports. So, but reports are really useful because you can look at millions of transactions all at once. Kind of hard to watch millions of things all at once. Okay? So anyway. So let's try this. Wages earned by employees, unpaid, unrecorded, are $2,700. The last payroll was December 28th. The next one is January 6th. So since December 28th through December 31st, our employees earned $2,700 that we have not paid them yet, and we have not recorded it yet. Recorded means what? Make a journal entry. That's it. That's also recognition. We recognize it in the financial statements. We write it in the financial statements. How do we get it in the financial statements? We make a journal entry. Got it? Okay, so that's recognition. What's realization? That's money. Realization is exchange cash, receiving cash or paying cash. That's it. Okay? So this one's not realized yet. We haven't paid it yet, right? But we need to recognize it, don't we? Is this an accrual or a deferral? What's that? Oh, no. No. What are we doing? With a 50-50 shot. Good you said something. What's the deal? I am going to accrue the expense. We're not talking about the cash. We're talking about the revenue or the expense. I'm going to accrue this expense even though I haven't paid for it yet. What would be a deferred expense? A prepaid. What's this going to be? A liability, right? Okay. Salaries payable. Okay? Same thing with the revenues. What's a deferred revenue? Unearned revenue, right? I got paid, but I'm going to earn the revenue later. Okay? And then what's an accrued revenue? An account receivable, right? I didn't get paid. So, all right. So give us a journal entry, though. What do you think it is? Debit. We used up their time. It's wages. We used it up. What is it?
Salary expense?
Yes, our wage expense, maybe. Wages and salary expense, maybe. They said wages, so we use that term. Wages is hourly workers. Salary is people who are making a monthly salary. Okay? That's all it is. Okay? Why is it an expense? You used it up. Excellent. What else do we have? Wages payable. Yeah, we wouldn't call it accounts payable because that'd be the vendors for inventory typically. So probably wages payable. This is an accrued liability. We even call it an accrued liability. Excellent. That's an adjusting journal entry, you guys. We made wage expense correct and we made wages payable correct. Is that a brilliant thing? Okay, good, good. Let's do B. Office supplies on hand, total $450 at the beginning. They purchased and debited to office supplies $500, so they debited office supplies and credited accounts payable maybe, and later paid the payable. The year-end count shows $275 of supplies on hand. What can you do with this thing? Here I think a T account's kind of handy because I've got several things to keep track of. So I have supplies inventory, right, everybody? What do the supplies become when I use them up? An expense named supplies expense. We're real clever about that kind of stuff. Okay? Excellent. So right now they started with how much? Beginning was $450. Then they made a journal entry debiting supplies inventory and crediting, well, credit cash or accounts payable or something, right? I doubt if they paid cash probably. Unless you went to, I don't know, if you went to Office Depot, is that what they call it? Is that the name of the store? Anyway, what that place is called. Anyway, Max or something. Anyway, you go to that store, right? And you pick them up, and if you hand them cash, I guess it's debit office supplies and credit cash, right? But if you have an account with them and they deliver it to you, what's it going to be? Debit office supplies and credit account payable. Sure. You know, so it just depends on how they did it. But in any event, their purchase is how much? About 500 with it. Man, they sure started with a lot. Anyway, that made them 950, right? Then they go count it at the end. Oh, you can find out how much you have by counting it. How about that? Count what they have and times the cost for each thing, right? Whatever the supplies are. What's the ending? And if you had 950, and now there's only 275 left, where'd they go? They're either stolen or used, right? Okay, hopefully used. How much is that? 625? 675. Okay, good. 675. Oh, okay. So do you want a credit supplies inventory for 675? Of course you do. And you use them, so what are you going to debit? Supplies expense. This is easy, you guys. There's nothing to it. Debit supplies expense. Credit supplies inventory. Okay, here's what you do. You figure out where you're at, figure out where you want to be, and the journal entry is easy. What do I mean by figuring out where we're at? I found out that we have 950 in the account, right? And then I found out that we only want to have 275 in it. Who could not make that journal entry? And if we no longer have the supplies, we know we used them. It's got to be supplies expense. Boom. We're there. Okay? Not hard, huh? It is bizarre having the chairs not move and having the tables move, isn't it?
Yeah.
When you reconfigure this room, though, it's really nice that you don't have to pick up the tables. But it's weird you have to pick up the chairs. Maybe they thought that if you had them both move, people would run around the room. And, you know,
Maybe put
we
little
could have,
box on
you know,
them.
table derby in here, you know.
Oh my,
Never mind.
there's no little box on the wheel. Where?
Oh, yeah, there is, I think.
Where?
Little thing you push there.
Hiding.
So you can lock your table in, and then when people try to move it, they'll swear about you. Okay, C. 1/4 of the basement space is rented to Hell's Supply Shop for $5.60 per month, payable monthly. On December 31st, the rent for November and December had not been collected or recorded. So they didn't pay us, so they're behind on their rent. Collection is expected January 10th, though. All right, guys, what do we need to do? What is this going to be? If we rent it to them, why do we rent it to them? So we can get richer. What's this going to be? Well, it'll be rent receivable or account receivable. Either one's fine, probably. Okay, the account receivable is usually for selling our product to somebody or normal services. This would probably be rent receivable. Make sense? So there's judgment involved. Okay, so yeah, we have a rent receivable. I agree. Is that an asset or what? I think it is receivable. Okay. So what do you want to do to it? Debit it. And how much do they owe us? Yeah, because it's 2 months, isn't it? You add the two together, right? 2 times it. Sorry, right? Got it? I guess you could add 2 months together or take 2 times it. Pretty good math skills, huh? Okay, anyway, 1,120 was it? So if you realize that first, it's great. It's an asset, okay? But why do they owe it to us? Because they haven't paid us. That's true. Why are they going to pay us? Because they used it, and that's how we make money, and by that you mean earn revenues. Okay? Right? We make money by earning revenues, yes. Okay? We don't actually print money, that's counterfeiting. Yeah, we make money by earning revenues. True? That's funny. All right, so what do you want to call this thing? Is, you know, for renting? You think it's unearned rent revenue?
But you've already
Oh, I love this. This is good. Let's look at his journal entry. Let's make fun of him. Here we go. He's a confident guy. He thinks because they didn't pay us, they owe us, and we owe them the use of the building. Really? No, they used the building. I don't owe them the use of the building.
What do you owe with them since they haven't used it?
No, they've used both months. They used November and December. It's December 31st. Oh. No, you can't defend yourself. This is ridiculous, isn't it? I can't have a receivable and then owe them too. They owe me the rent, and I don't think anything happened there. So what really happened was they used the building, didn't they? So it's not unearned. What is it? It's earned, right? It's rent revenue. Everybody see that? Okay, what is this thing? Accrual or deferral, gang? They have not paid me, but I earned it. What do you want it to be?
a deferral.
Oh, God. We're not deferring the cash. It's not about deferring the cash. It's about deferring the revenue. If it's a deferral, that would be unearned revenue.
Okay.
So even though I did not get the cash, I have accrued the revenue. When we say accrual and deferral, we're talking about the revenue and expense, not the cash.
Okay.
And that's what you're mixing up.
Okay. Yeah.
Okay, there we go. All right. And that's not a real big deal, by the way.
Okay.
It's not.
Okay.
But it helps to sort of understand, right? Kind of does. Okay. So, all right.
I have
So-
a question.
Yes, sir.
Why'd you do 1,200 for rent revenue?
Oh, because I wrote down the wrong thing. Because I love to have my general ledger out of balance, I guess. No, it's got to be the same number. Okay, exactly. I apologize. Okay, I was having too much fun. Sorry. Okay. So, yeah, that's an accrual. What about this one? That's an accrual of a revenue, right, guys? What's this one up here? You can answer it again. This time, go for it. What happens? I have not received or I have not paid the cash, I owe them, but I have incurred the expense, so I'm going to debit the expense even though I haven't paid for it, so I am what? Accruing or deferring the expense, everybody? It's an accrual. This is an accrual. This is accrual. Now she's refusing to answer anything because I'm going to pick on her. I heard that. Yeah, it's fun to pick on her. I don't get paid. I just get to torture students. That's it. So yeah, that's an accrual of revenue, isn't it? What would be a deferral? I'm sorry, that's an accrual of expense. Oh, God, gee. What would be a deferral of expense? I paid for it, but I didn't use it. And what would I have? A what? No, I paid for it, but I didn't use it. I'd have prepaid. I'd have a prepaid asset. Yeah, prepaid expense and asset. Okay, what would be a deferred revenue? They paid me, and I have not earned it yet. That'd be debit, cash, and credit what? Unearned revenue. Yeah, unearned whatever it is. Yeah, absolutely. Okay. So, yeah, just scaring me. All right, not really. It's hard to get your head around. Okay, the store used delivery equipment that cost $60,500. $12,100 is its estimated depreciation. Okay, this is something new. Okay, what's going on? I bought a piece of delivery equipment, so I have delivery equipment with $60,500 in it, and now I'm using it. Okay, now here's the deal. Every asset except for land, because land doesn't really go away, every asset that we buy, why do we buy it? To use it, generating revenues, absolutely. You know, I remember when I drove from Mushroom Farms, the marketing manager had so much fun buying our first pretty semi. We had ugly trucks, it's a small company, and he bought this gorgeous semi. It had our label on the side and all the company colors, and it was really, really nice. And the way that he justified buying that was, well, when it went down the road, that was advertising. Really, he just liked it. So cool. And we all like trucks. Trucks are cool. And so the big freight liner. And anyway, but how did we convince the president of the company to buy that truck? Do you think it was because it was pretty? Or do you think it was because we were going to be able to really efficiently deliver a whole lot of product? And oh, by the way, it's an advertisement driving down the road. And it made us look like we were a big company and fluent and all that stuff, which was a smart thing, because we were a little tiny company, right? We got our name out there more. Okay? And the company existed for a long time. The product was in the stores and stuff, like a label. But we were selling more and more fresh product. So there's no label on a fresh mushroom, right? We wanted to keep our brand out there. So there were reasons for this thing. Anyway, how do you justify the couple $100,000 for that truck? Revenues that are going to be generated as we use it up. And the reality is, do you use up a vehicle once you buy it? I have a Miata sitting up over in the R lot, right? It's got 80,000 miles on it and it's 15 years old. It's not worth much of anything anymore. Well, it's a Miata, so somebody's tipping up and giving me $12,000 for it. I don't really care what it's worth, though. I'm not going to sell it because I can't afford to buy a new one, right? It's fine. Okay, so what's the deal with that thing? Is the car still there? Yes. Is it pretty much used up? Yes. Oh, how do we do that? What we're going to do is we're going to leave the delivery equipment at $60,500, and we are going to use what is called a contra account. Contra means opposite or opposing, right? Opposite the normal balance. And the contra account is called accumulated depreciation. Now, at this point, I'll have to do the same thing I did in the last class to tell you the truth that I lied to you. I told you there's only 5 accounts. It's a little white pocket, just to make it life seem easier. This is not a very big deal. Instead of 5 accounts, assets, liabilities, equity, revenue, expense, there's 10. There are also contra assets, only a few of them. There are contra liabilities, a few of those. Contra revenue, contra expense, only a couple of those, right, of each of them. Okay? There's even contra equity. Contra equity is a dividend account. It's got a debit balance. Okay, now think of contra. Assets, how do you increase them? Regular assets with a debit, reduce with a credit. Guess what you do with a contra asset? How do you increase it? Credit, how do you reduce it? Debit, how about expense? Same thing, right? Kind of the opposite of normal. How about revenue, equity, and liabilities? Ordinarily, you increase them with credits, so with these, you increase them with debits, reduce them with credits. You guys know everything about them now, don't you? As soon as you see one. So what we're going to do is we are going to accumulate on the credit side here in accumulated depreciation the amount of that equipment that we've used up, okay? And then what we're going to show on the balance sheet is equipment, delivery equipment, right? And this is the same for buildings because we depreciate that too. So delivery equipment we'd show at $60,500, right? This is going to be on the balance sheet. And then we're going to show accumulated depreciation accumulating over the life of the thing. And the difference between the delivery equipment and the accumulated depreciation is going to be its book value or its net, book value being in the books in the general ledger, get it? Book value or carrying value, which is also going to be called net delivery equipment. You like it? Now, if I was using up supplies inventory, I would just credit supplies inventory, wouldn't I? But as I use up the equipment or building, it doesn't go away, right? Supplies inventory really does. It goes away. So does merchandise inventory. So does a prepaid. It goes away. But in this case, we still have the truck, right? It's just getting old. Got the idea? That's it. Okay? So when you look at a balance sheet, you can see how much they paid for the equipment and what the accumulated depreciation is, and you have an estimate of how old it's getting. If there's very little accumulated depreciation, it's new. If it's almost as big as the equipment, it's about ready to replace it. And you can predict what's going on with the company. Lots of information here, okay, in financial statements. And we'll gradually get there. Okay, so what did they say the first year was? 12,100. You know what? If there's 12,100 of depreciation, how long do you think this asset's going to last? They bought it the first day of the year, did they? Right at the beginning? So what's the cost of this asset? In a couple of chapters we'll be doing this, building and equipment. What's the cost? $60,500. If we assume no salvage or residual value, which is what they did, I can kind of tell by their numbers, right? Salvage or residual is what I'm going to sell it for at the end of its life, okay? So the depreciable value, we call this, is $60,500, okay? That's what we're going to do later. What do you think the life is of the thing? What did they say the depreciation is each year? 12,100? 12,100? Oh. The life, if we use straight line depreciation, which means the same amount every year, must be what if 12,100 is the amount that gets depreciated every year? 5 years. It's a 5-year life. So a piece of equipment lasts 5 years. For our purposes, then we're going to get rid of it. Okay? It's not going to be really gone after 5 years. It's just going to be used up for our purposes. We might be driving it 50,000 miles a year, or 100,000 miles a year, or 200,000 miles a year. I don't know what they're doing with delivery equipment. Okay? So obviously your life is partly based on how much you use it, and partly based on your time going by. Both, right? By the way, on my Miata, 80,000 miles is not very much on a car, is it? How about 15 years, though? That's all. That's a lot. Okay? Yeah.
So is accumulated depreciation a contra asset?
Yes. So how do we record the journal entry then? That was a great question. Leads right into it. This is using up the equipment or the building. When we're using it up generating revenues, right? Using it delivering product or something, it's delivery equipment, delivering stuff. Okay? So it's a cost I incurred to generate my revenue. So what do we call those expenses? You're going to debit expense, aren't you guys? For 12,100. Name the expense for me. We call it depreciating the asset. What do you want to name it? How about depreciation? So absolutely. And what are you going to credit? I know we're all tempted to credit equipment, Tom, because the equipment's going away, but it's not. Its useful life is being used up. Its usefulness is being used up, but the equipment's still there, right? So we'll leave the equipment at $60,500, right? We'll leave it there in delivery equipment. What we'll do instead is credit accumulated depreciation on delivery equipment for the 12,100. Got it? So that's exactly right. That's what you do, is the contra account. As that contra account grows year after year, what happens? We have an asset cost of $60,500. At the end of the first year, we have $12,100 in accumulated depreciation. What's the net delivery equipment value? $48,400. Is that right? That's what we show on our balance sheet. Everybody getting the picture of this thing, how it works? Okay? So now you know how contra accounts work. Pretty cool, huh? All of them are going to be the same way. Okay? It's just reducing the other account that it goes with. Okay. What would happen the second year? This is the journal entry. What would happen the second year?
So you don't record the
initial cost.
6,500.
Oh, they would have recorded the initial one, yeah. It would have been debit equipment. It's not required, no problem. They would have debited delivery equipment for $60,500. Let's say we gave them a $10,000 down payment, right? You'd credit cash, wouldn't you, for $10,000? And we already did this, didn't we, on the earlier quiz, right? So yeah, same stuff. And then how much must we borrow? $50,500, and what would that probably be?
No.
Well, not accounts, probably notes payable. Because accounts payable, they're trusting you to pay them. $50,000 bucks. What do you bet they'd have you sign a note and pay them interest? So it'd be either notes payable or contracts
No
payable.
interest on accounts.
No interest on accounts payable. Because you're getting paid within 10 days, 30 days, something like that. Okay, good question. All right, does this do it? By the way, what would happen the next year? We do exactly the same entry. But now what would that make accumulated depreciation if you put another $12,100 in there, everybody? $24,200. And now we'd have $24,200. Getting the idea? In accumulated depreciation. So what would be left to depreciate? Remaining book value. $60,500 less $24,200 is how much? 36.3. Well, guys, imagine that we do that 5 times, right? What are you going to have in accumulated depreciation if you do 12,100 5 times? 60,500. What are you going to show on your balance sheet? Delivery equipment, 60,500. Accumulated depreciation, 60,500. What's the remaining book value? 0. You've used it up, but you still have it. Okay? That's all. What would you do when you get rid of it? Retire the equipment and the accumulated depreciation, which we'll do later. Okay?
So what if you, like, maybe you use its book value, but you can still sell it?
Then you have a gain when you sell it. Excellent. If I could sell it for $3,000, I have a gain of $3,000.
Okay.
But that would be my salvage value. I'd estimate the salvage value here, that's my estimate of how much I'm going to sell it for at the end. Do I really know what I'm going to sell it for? Of course not, right? I'm estimating. But that's what we do. We'd estimate and try to get close. But then when you sell it, you still have a gain or loss. Absolutely.
Okay.
Could I sell it before I depreciate it for all 5 years? Sure, you can sell it anytime you want. By the way, we don't make people run their business to fit their accounting system. We design the accounting system to fit the way they run their business. Sound better to you guys? I think that's a lot better idea. I don't decide what I'm going to sell to my customers based on whether or not I can account for it. I'm not going there. Right? I'm going to sell whatever my customers want to my customers, and at whatever price I can get. That's it. God, I wasted another hour and we did nothing. Oh well.
Final answer.
Keep studying, guys. Yeah, that's the final answer.
That one is you want it for
Yeah, they wanted the first year. Got it. These are easy, aren't they, though? All this is easy. Emphasize, like I do in class when you're studying, emphasize knowing what you're doing versus doing a whole bunch. That makes sense? It'll take you less time and you'll be more successful.
I have a class right now, so can I bring it on Monday to the review session?
Yes.
Okay. Thank you.
Oh, absolutely. We can look at it anytime. I'll probably end up giving you no points, but I'll look at it.
I just wanted to know.
Unless
what it
I
was.
screwed up. If I screwed up, I'll do it. Okay, every time.